Welcome to the Daily Update Podcast, where I'll go over the action in the market for Friday, August 15th, and we'll see how things look for Monday, August 18th. Going over what happened in Friday's session, the S&P 500 opened strong, hitting a new intraday all-time high at R1, which was at 64.81. However, the momentum faded quickly, and the index closed down 0.29%, settling just above the S1 support level at 64.48 after dipping below the daily pivot at 64.61. The Dow followed a similar pattern, reaching an intraday all-time high, but failing to secure a new all-time closing high. Trading volume remained below average, which is typical for the summer months, but the lack of follow-through buying signaled some underlying weakness. Despite this, the broader market remains positive across the short, intermediate, and long-term time frames. Looking into the key observations of what is driving market sentiment, inflation concerns are starting to creep up again after Thursday's stronger-than-expected PPI. This raises inflationary pressures, which could spill over into consumer prices as measured by the CPI. This has helped push interest rates higher, with the 10-year yield climbing to 4.33%, inching closer to the critical 4.5% level. Chicago Fed President Austin Goolsbee, now a voting member of the FOMC, cautioned against overreacting to a single data point, but the market remains on edge. Geopolitically, the ongoing summit between Presidents Putin and Trump in Alaska has yet to yield a deal, though their face-to-face discussions are a positive step. On the economic front, retail sales on Friday met expectations with a 0.5% increase, down from the prior reading of a 0.9% increase. The Empire State Manufacturing Index surprised to the upside at 11.9, beating forecasts of an unchanged reading. However, import prices rose 0.4%. This reinforced inflation worries, while industrial production and capacity utilization showed slight weakness, coming in as expected at a negative 0.1% and 77.5% respectively. Consumer sentiment also disappointed, dropping to 58.6 against expectations of a reading of 61.3. Turning to sector performance, there was a shift towards defensive sectors on Friday. Healthcare and staples outperformed, suggesting some bargain hunting or caution among investors. Meanwhile, the financials and technology did lag, with financials raising particular concern due to their underperformance relative to the S&P 500. Mega-cap stocks, though, did hold up better than the small caps, which lost some of the momentum they gained earlier in the week. Looking at the technicals, short-term momentum indicators, including the stochastics, CCI charts, and Williams percent R, remain positive but did weaken on Friday, reflecting the day's choppy action. Intermediate-term indicators, including the Shan Trend Meter, moved from overextended to just extended, signaling a need for caution as it declines. The S&P 500 faces long-term resistance at the 64.68 weekly pivot level, closing just below it on Friday. A failure to break above this level could lead to a consolidation or a pullback. The VIX ticked up but still remains well below 20, indicating relatively low volatility for now. However, the SKEW index suggests the market is bracing for a potential big move, though it's unclear whether it will be to the upside or downside. Growth-to-value ratios remain positive but are softening, with large caps outperforming mid and small caps. Negative divergences still persist, though they are showing signs of improvement in some areas. Seasonally, August is a challenging month, particularly in post-election years. Historical data going back to 1950 shows no positive August in such years, and the week after options expiration, which we just had, is down 55% of the time, going back to 2002. These trends suggest investors should stay vigilant. Looking ahead to Monday, August 18th, the NAHB Housing Market Index will be the only report released. Later in the week, the FOMC meeting minutes will be released, which the markets will dissect for any clues about a potential September rate cut. Expectations have shifted from a focus on a 50 basis point cut to a more modest 25 basis point cut, and further inflationary data can even put that in jeopardy. Fed Jerome Powell will be giving a speech on Friday and will also be critical, as his comments often move the markets. The S&P remains positive across all time frames, but the 64.68 resistance level still looms large. Weakness in small caps and financials, combined with inflation fears and geopolitical uncertainty, could drive volatility. Seasonally, Monday is neutral to positive, but the historical weakness in the week after options expiration warrants caution. A failure to break above 64.68 could lead to more consolidation, while a breakout could signal new all-time highs. In conclusion, Friday's session showed that the S&P is testing new heights but struggling to maintain positive momentum amid inflation concerns and technical resistance. While the short and intermediate term trends remain constructive, negative divergences and seasonal headwinds suggest a cautious approach. Monday's session will likely hinge on upcoming economic data and the FOMC meeting minutes, with inflation and geopolitics as key wildcards. I hope you found this podcast helpful. For more in-depth analysis and commentary, the full-length daily video update is available on YouTube and Rumble right when the market closes each day. To access the videos immediately after they are available, or to access the daily newsletter, please click on the links below.